So where's the real funds rate today? It's not negative. It's over 2%. And it's exactly, by the way, where it's been in the past before economic recessions. So I know I'll be accused of being the boy who cried wolf, to which I say, just remember that the wolf does show up at the end of the story. Will the Fed have to go back and re-embark on QE? Absolutely. As much as we hate it, we're going to need it. So I think yields are going to come down, and that we'll get probably a nice double-digit return in the 10s and 30s over the course of the next 12 months. But I think you have to be a little patient here, because I don't think these signs will start to show up until we're probably into the third quarter.
Hi, everyone. I'm Maggie Lake, and today I'm talking markets and macro with David Rosenberg, founder and president of Rosenberg Research and Associates. Hi, David. It's great to have you back on.
Great to see you again, Maggie. One of these moons we'll have to do this face to face. But
I would love that. I would love that. And we will make that happen.
Thanks for having me on.
Sure thing. And I'm excited about it because I think this is a time when experience really matters, and you have seen your share of market cycles and financial crisis. I mean, your first day of work was the 1987 crash. So I feel like this is a perfect time to sit down and get your thoughts. And we are clearly seeing strains in the market. When you look at the days, and they seem to be more frequent, where you have U.S. Treasury bonds, stocks, and the dollar all selling off at the same time. That's often a signal that something bad's coming. Is something bad coming?
Well, I don't want to deliberately sound like Eeyore the donkey, but I think that if we're going to take our cue from the Treasury market, and this has been a phenomenal run up in yields from where they were just 2 months ago, and you deconstruct it, and you can see that it's not really been about inflation expectations becoming unhinged, and it's not about real interest rates surging because there's some broad expectation of reaccelerating economic growth. It's come almost exclusively from the term premium, which is at its highest level in over a decade, and actually about 100 basis points higher than what the norm has been over the past decade. And so I think that the bond market is responding really to two different policy shocks. One is the uncertainty over trade and tariffs. And then, of course, after Liberation Day, which I guess liberated us from our sanity level, we then had the Great Reprieve, although nothing's really been settled yet. And we'll have to see what happens, I think, on July 9th when the reciprocal tariff reprieve comes off the books. And I don't know about you, Maggie, I haven't seen anything deal-wise that would cause the administration to back away, but back away they may do. I think that's what a lot of people think, that they tried this reciprocal tariffs. It caused the markets to plunge, major risk off trade. So they'll find a way somehow to save face, or maybe have their trading partners help them save face. But we get through that, and then we get through this fiscal situation and the big, beautiful bill. But there is a big tab to this bill, and that is what is unnerving the Treasury market right now. And what's happened is that we have tacked on a significant fiscal premium out to the longer end of the curve. So this is not some benevolent run-up in market interest rates that you could say, well, it makes perfect sense that rates would back up. That we have accelerating growth expectations, price pressures brewing, tightening labor markets, the Fed's going to raise interest rates. And that's the benevolent increase in interest rates, the sort of increase in market interest rates we would have had, for example, in 1983, and that we would have had, for example, in 1993, that we would have had in 1999, that we would have had in 2009, coming off the Great Recession, or, for example, what we would have had, say, in 2022, coming off of the COVID scare. This is none of those. This is an exogenous interest rate shock that we're seeing right now. And it's because of all the policy uncertainty. And, you could measure uncertainty. There are uncertainty metrics that go back decades. And we're in a 3 to 5 standard deviation event. And it's showing up more in the risk premium in the stock market. People are scared to take on duration risk. I don't know how we can square that with a 21 forward multiple on the S&P 500, or square that with a 20 reading on the VIX. But you usually find that the bond market in situations like this leads the stock market. So when you ask me, is this a foreshadowing of something nasty happening? Well, it wouldn't be the first time. And the one thing we do know is that the bond market does lead the stock market. And it'd be one thing if this was coming early in the cycle with the Fed embarking on a tightening phase and economic growth accelerating, but you see that's not happening. This is something different. The run-up in interest rates is because of the heightened level of uncertainty that's causing investors to shun and shed duration exposure. And then that feeds right through back into the economy with a lag. The housing market being the most interest and credit sensitive, the impact it has on the general level of the corporate cost of credit and everything that's priced off the Treasury curve. This all operates with a lag. Even before we get any fiscal stimulus, this is going to have a dampening impact on economic activity when we already know that the economy is actually pretty weak. We can look through the negative reading on first quarter GDP, but the economy, if you're taking a look at the trend, the monthly trend in GDP, it is softening. And we've had a bit of a skew because of all the pre-buying activity and the pre-ordering and inventory built up ahead of the tariffs, which created this, I think, false illusion that the economy is doing fine. The economy is really not doing that fine. And now we're going to layer on this interest rate shock that's really devoid of what the Fed is doing, just to show how little control the Fed has. When you go back to the jumbo rate cut back on September 18th, the 10-year Treasury note yield is up about 100 basis points since that time. So, you have the president openly lambasting Jay Powell, but the Fed only controls the front end of the curve. And it's investors that control yields out the curve. And those are the yields that matter the most. So, I go back and take a look at what happened, for example, when I started the business in 1987. We had a monster bond sell-off at that point. And when I started in the business, all we talked about were the twin deficits, trade deficit, fiscal deficit. Now these deficits are on steroids. And bond yields surged. And the next thing you know, we had the crash of 87, we call it Black Monday, October 19th, 87. And that's the day that I started as a street economist. But before Black Monday, over the weekend, they were calling it Black Friday because the plunge, the 23% plunge on October 19th, 87 happened after a horrible Friday. But you see, that was a case where bond yields were surging through the summer and into the fall. And the bond market led the stock market. The bond market always leads the stock market. And I just go back to, I'm not going to say the most recent experience, but the most glaring experience I remember was when you had, for whatever reason, it was still a bit of a spotty economy. The Bernanke Fed was done tightening. This is the summer of 07. And out of the blue, 10-year Treasury note yields started to spike. And there was some sort of fund flow impact taking place or selling of collateral because we were just in the throes of a mortgage crisis. At that point, there was mortgage problems brewing. We didn't know it was going to come a mortgage crisis for 6 to 12 months down the road. But I remember sitting at my desk and I remember talking to our bond strategist at Merrill Lynch saying, like, how did the 10-year note just ratchet up to 5.35% out of the blue? And the next thing you know, the stock market peaks in October and then never looked back. So yeah, I would say that that the nature of this bond yield backup not being predicated on anything related to the real economy, but really related to an exogenous shock taking place on fiscal policy. This is where fiscal policy, if you're thinking it's going to be stimulative and you're going to buy equities because of the big, beautiful bill, be careful what you wish for, because the bond vigilantes rode in full force. It'd be one thing, as I said, if we had an acceleration in growth right now, we could withstand this run up in interest rates. And it's taking place without the Fed doing anything. The Fed might not end up be doing anything for quite a while, and the markets have started to price that in. But we've had a major ratcheting up of rates, even with the Fed just being on hold. And it goes to show you that this has nothing to do with the Fed, nothing to do with the economy, but it's going to end up biting the economy in the tush. And with a lag, it's going to create some problems for the stock market because the math doesn't make sense that you are going to have a 5% plus long bond yield and a 4.6% earnings yield in the stock market. You're talking about a negative equity risk premium. And when we've been there in the past, it hasn't really been a very good sign. You either need rates to come down. If you don't get that, then valuations come down. But because everybody lives in the here and now, I mean, to most people, tomorrow lunch is long term. Everybody says that they're a long term investor, but they're looking at their stock quotes every 15 minutes. Oh, but I'm a long term investor. But the bond market is sending you a message. I think the dollar is sending you a message. I mean, you mentioned that about the dollar. I mean, this is very strange. And the question is, what is the message? Because historically, the country imposing the tariff is the country that sees its currency appreciate. And the dollar is slip sliding away. The only central bank that isn't cutting interest rates is the Fed. ECB is cutting rates. The Bank of England is cutting rates. The Reserve Bank of Australia just cut rates, although the Bank of Canada took a pass at the last meeting. The BOC's been cutting rates for over a year now. Only the Fed's not cutting rates. Normally, that would be leading to a stronger currency. And instead, the dollar is going away, is going down. And all the major averages are going down for the DXY. So telling you we are in a fundamental bear market on the US dollar. And I think that might be telling you something about an increasing lack of confidence over U.S. domestic economic policy.
So I think a lot of people understand that the bond market is saying, we demand more based on what's happening fiscally. Have we seen the move? Has that reset happened based on what we've seen in this spike of yields, or is this just getting going? Where are we in the response?
I'm tempted to think that the worst is behind us on the Treasury market, but I'm predicating that on my view that we are going to be seeing the recession that everybody is scared to call for right now because so many of us, including me, got it wrong in 2022, 2023. Everybody is once burnt, twice shy. But that's not me. I don't get once burnt, twice shy. I admit that I'm wrong, explain why I'm wrong, and I move on. But I don't let an experience from 2 or 3 years ago, I don't let a missed call from yesteryear influence what I'm going to be doing going forward. That's just called being fearless. But also understanding that what's different this time around is that we don't have $2 trillion plus of excess pandemic savings. The Energizer Bunny that kept on going to keep the consumer intact through that Volcker-esque type of tightening cycle, those savings are gone. And it's uncertain as to how the tax cuts in this big, beautiful bill are going to play up against the spending cuts. There's going to be winners and losers. So it's really uncertain how that's going to play out, assuming that this bill does get through the Senate. We'll have to see. That game's not totally over. And at the same time, the Fed is keeping policy deliberately tight. And I'll tell you, Maggie, going back to what I talked about before, one of the mistakes that I made that I learned from as I was pounding my fist on the table about how tight the Fed was becoming in 2022 and 2023, that through most of that tightening cycle, the Fed funds rate in real terms was still negative and didn't poke its nose into positive territory until April 2023, when the tightening cycle was almost over. So where's the real funds rate today? It's not negative. It's over 2%. And it's exactly, by the way, where it's been in the past before economic recessions. So I know I'll be accused of being the boy who cried wolf, to which I say, just remember that the wolf does show up at the end of the story. So because I have a recession view, because in my business of forecasting, your projections hinge on your assumptions. I'm assuming that the recession that we dodged a bullet, we're not going to dodge a bullet this time around. So I think yields are going to come down and that we'll get probably a nice double-digit return in the 10s and 30s over the course of the next 12 months. But I think you have to be a little patient here because I don't think these signs will start to show up until we're probably into the third quarter. I guess you'd say this only a couple of months away. But a couple of months away for most people is like eternity. But I think you got to be a little bit patient. We've got to have more of an overshoot. And unless I change my view, I'll use the overshoot as a buying opportunity to extend duration, just as everybody else is throwing in the towel, which from a sentiment perspective is actually a pretty good signpost. If we don't get a recession, and if the stock market goes to make new highs on solid breadth and strong volume, then I'll have to go back to the drawing board once again, as economists do, and go back to the drawing board and say, well, here's where I went wrong this time around. But that's my base case, is that I'm not going to be wrong this time, but we always say that. But really, it'll be the economy and the stock market that will determine whether or not there's going to be more pain in the bond market. I think there's enough pain right now, and you actually see it in the quintessential leading indicator. To this day, the leading indicator of the economy is not generative AI, and it's not ChatGPT, and it's not robots. It is the housing market still leads and has so many powerful multiplier impacts through the goods part of the economy and the services side. And the housing numbers are rolling over in dramatic fashion. Like I'll tell you right now, the one, we all focus on, what's the Mag 7 doing and what are the tech stocks doing, what are financials doing. Nobody talks about the home building stocks. And the home building stocks, Maggie, are down 35% from the nearby cycle peak. And when I tell people that statistic, they don't know it. Their eyes glaze over. But I think that will end up being a leading indicator for a resumption of either the severe correction or bear market in equities. I think that we'll then see more of a risk-off trade. That should benefit the Treasury market. I think all the fiscal issuance that we're going to see, and all the bond issuance we're going to see, is going to limit the bond rally. But I do think that if you're looking in the next 6 to 12 months where you park your money, I think the long end of the curve is going to be a pretty good place to be.
David, people are going to hear you say that and say, this guy is out of his mind. I've heard people say the U.S. Treasuries, the bond market looks uninvestable based on the fiscal situation. This is the day of reckoning. It's finally come for the U.S. Treasuries are no longer a safe haven. This is the who's buying treasuries now. This is a massive rotation out of U.S. assets, including treasuries. There will be a repatriation. People are going to keep their money at home, funnel it to infrastructure projects in Europe, or repatriate it in the case of Asia. How do you feel like it's safe to be a bond bull right now, when you've got all those other arguments out there?
Well, there is a lot of hyperbole there. There's no doubt about it. we hit a cycle peak of 5% in the 10-year note back in October 2023, and those same people were saying the same thing back then, that the COVID-induced inflation will never go away, that the Fed is going to have to take rates to the moon. Ultimately, inflation did come down, and the Fed did stop tightening policy. And it went from 5% down to 3.6. Then we backed up to 4.6. And I could just say simply, look, we're just been caught in this range from call it 3.6 to 5, and we're heading to the high end of the range. But you don't agree that that's hyperbole? Like, basically, I would say that, if we go to 6%, okay, that's, but I mean, the way I see the situation is that you've also got other situations. You mentioned before, we have the fiscal tourniquet being taken off in Europe, led by Germany. We've had problems in the Japanese bond market, where you have a situation where the BOJ no longer supports the market like it used to, and at the same time, it's like the boy with the finger in the dike and is scared to normalize policy. So the BOJ has made a huge mistake by sanctioning an elongated period of negative real rates, even as inflation there. Who would ever thought we'd talk about inflation in Japan? But inflation is rising in Japan, and the BOJ has been slow off the mark. And I think the bond market is telling the BOJ that it has allowed itself to get way behind the curve. Tough for me to believe that with the Fed funds rate pinned, call it 140 basis points above the Fed's own estimate of neutral, that the Fed is behind any curve. If anything, the Fed is probably behind more the growth curve than the inflation curve. So let me explain the rationale, because we all know that the 1970s was a period of stagflation, and actually a period where very rough for the bond market, and rough for the stock market too, especially if you looked at the stock market in real terms. It was a fundamental bear market through the entire decade, but inflation can mask a lot of that. But we had three recessions, 1970, 73 to 75, then we had the last one heading into 1980. And in the three recessions, your returns in the Treasury market were positive, significantly positive, and far outpaced what you got in the stock market, because you have to put your money somewhere, and did better than cash. Now, that obviously wasn't the case throughout the entire 1970s, but in the periods where you had the outright recession, bond yields were flat to lower. At a minimum, you clipped your coupon. Bond yields, interest rates in general, do not go up in economic recessions. Why is that? Well, firstly, you get a fund flow move from risk-on assets like equities into risk-off assets like bonds, point number one. The other fund flow aspect of it is what happens in recessions. As you lose your job, as you risk bankruptcy, you dramatically cut back on your credit demands. Take a look and see what bank lending does, or what new issue activity the private sector does in recessions. You focus on your balance sheet. You focus on liquidity. You stop borrowing money. And it just so happens that because the automatic stabilizers kick in, the deficit at the government level always goes up in recessions, but curiously enough, bond yields go down. Why? Why is that? Because you have to take a look at the entire funding pie. And what happens in recessions is the credit demands in the private sector contract so much that it offsets the increase in government borrowing, and that allows for interest rates to come down. That is a supply-demand framework that always leads to lower yields out the curve in periods of economic contraction. And so that's how I would attack that. Yes, the deficit is intractable. Does it mean that bond yields will go up in a recession? No, they won't. The only way you get out of a recession, Maggie, unless we're going to talk about, will the United States go into a perpetual recession? Well, not even I believe that, and I'm probably consistently the least bullish or most bearish person in the world. If we go into recession, which is my forecast, I don't know what your forecast is. If we do, how do we get out of it without lower interest rates? How is
Mm.
that going to happen? We're going to need to have much lower interest rates. Will the Fed have to go back and re-embark on QE? Absolutely. As much as we hate it, we're going to need it. So, no, I'd say that if your view, once again, it's about your assumptions driving your conclusions. If you are bullish on equities, and if you believe that the U.S. economy has become recession-proof,
Mm.
then you're certainly not going to want to adopt my forecast. But because I believe that the economy is making that transition, and you see it in the soft economic data, but these soft data tell you a lot about, and that's my entire profession is about behavior. It's about patterns of behavior. The survey data that people poo-poo, oh, it's soft. It contains a lot of information. Not that it always gets it right, but they lead. And the hard data are coincident to lagging. So I'd say, yeah, I believe my contention is that we're going to have a recession that's going to surprise a lot of people. And the Fed will be cutting rates. And they'll be cutting rates a lot, much more than what's priced in. What's priced in right now is next to nothing. The curve will steepen. Rates at the front end will go down more than rates at the back end, but the whole curve will go down. And I would be the first to say that the borrowing activity from the federal government will limit, but not impede the rally in treasuries I see forthcoming. If we don't get the recession, then this call is going to be wrong.
So let me ask you,
But it is my base case nonetheless.
is it possible to have a recession if Congress pushes through tax cuts and spending? If they hit the fiscal gas, will that prevent a recession?
Well, how much fiscal gas are we going to be getting? Because a good part of this deal, don't forget that most of what you're talking about is just extending the 2017 tax cuts on the personal side. Really, that a lot of that quote, it's not even real stimulus. It's maintaining the status quo. It's preventing falling off the fiscal cliff.
Hmm.
But if you're going to tell me, are you really going to tell me that no taxes on tips and no taxes on Social Security is going to save the economy from a recession? Like, are you really trying to convince me of that? Because I'm begging you not to. And then don't forget that there's all the other spending cuts that are coming, right?
Right.
It's not a one-way street. If there were not spending cuts coming, then most of the Freedom Caucus wouldn't have been voting as they did in the House. So there are also associated spending cuts. I look at fiscal policy as being broadly neutral at best. And what we have in our hands coming up is a tariff shock, and we're in the early stages. Remember that Liberation Day was April the 2nd. Wasn't that long ago. We're still in the throes. Now, people think this is behind us. I think they're dreaming in Technicolor. We have the Fed keeping policy deliberately tight. Right? What are you going to tell? Like, so where's the vitality from no taxes on tips? Are you really going to tell me that's the economic vitality? The rest of the world is flat in its back. Whatever happens, like right now, like we don't know what's going to happen on tariffs and trade because everything changes so quickly. But let's just say that we have the status quo. What's the status quo? Going into this tariff and trade war, the U.S. tariff rate on the rest of the world, the effective tariff rate was 2.5%. On Liberation Day, when we started to panic, that number went to like 28%. Now it's at 17%, which would be the highest since 1934. That's what? That's like a 15 percentage point attack on a $30 trillion beast called global trade. And everybody is just whistling past the graveyard. So the question is, how will that impact the economy? How will that impact the economy? There's so many people that believe. I cannot believe there's so many people that have bought into the view from the White House that it's the foreign producer. But it's the domestic importer in the United States that pays the duty. And then the question is, how much is going to get shared? The goal ultimately of these tariffs is to induce companies to come set up shop in the United States and make Appalachia great again. And if that never happens, it's going to take place over many, many, many years. I'm not going out that far. I'm talking about the here and now. The here and now is that the consumer is going to face at least part of this price shock. And it's happening at a time when you look at the JOLT survey. I know people, all I hear is about the 4.2% unemployment rate, as if that's significant. I could show you like half the recessions in the past started with the unemployment rate where it is today. And people get stuck on the levels of the unemployment rate, which are meaningless because it's the change in the unemployment rate. People tend to forget the unemployment rate is up almost a percentage point, 0.8 from the low. But we've reached a point where you're taking a look at the leading indicators and you look at the JOLT survey and you look at where the trend is in the hiring rate and the job opening rate. You see very clearly labor demand is coming down like a hot knife through butter. Now, companies are hoarding labor, and you see that in the low firing rate, and you see that in the jobless claims data. But look at the backlog of continuing claims. They're basically at a 4-year high, like roughly 2 million. Very elevated. So the backlog of unemployed are not finding a job. The people who've been out of work are not finding a job. So companies are not firing, but at the same time, they're taking down the for hire signs off their front door. So the labor market is becoming quite sclerotic, but you're getting to a point where if the job opening rate continues to go down and the hiring rate continues to go down, as it has, even with the low firing rate, we are going to be faced with net job losses. We will have non-farm payrolls going down. What has been the missing link all along? Because we've had spotty auto sales, retail sales, housing we know is in its own recession right now, rolling recessions in manufacturing, we know all that. What is the one thing that has not happened since the worst part of the pandemic is net job loss. And the only number that investors pay attention to and the Fed, which is non-farm payrolls, which, by the way, half the numbers we're seeing for the past year have been the birth-death model, which is a separate model. But even with that skew, non-farm payrolls have yet to decline. There's nobody that will believe my view. And I know that you said people will think, I don't know what the word that I'm out of my mind. Yes, because people are taking the past and extrapolating to the future that we will never see non-farm payrolls go down again. Yeah. But you see, that will be when the markets see the whites of the eyes of the economy. Because the one thing that did not happen in 2022 when the bunch of us got the recession call wrong, employment never went down. Of course, we had the excess savings propelling the consumer. But you never had a recession without employment going down. That's what we need to see. But when you're taking a look when you open up the engine and you look at the labor market, and I cannot believe, that's why I call G. Powell the biggest cheerleader. It's incredible. Because if you're taking a look at what is happening under the hood, you look at the engine, it's sputtering in the labor market. And so we start to see employment declines, Maggie. Okay, we start to see non-farm payroll start to go down later in the summer, into the fall, which I believe is going to happen. That will be a shock. And you'll have wished that you bought into the sell-off in Treasuries. I really find it fascinating. I watch all these people, Bloomberg TV and Fox Business and
CNBC.
And on CNBC, right? They get these, I guess you call them perma bulls. When the market's sinking and they're saying you gotta buy, it's like the anchors are fawning. They're fawning over these people, buying opportunity. But you see, if you tell people that I actually think that there's value in Treasuries after this sell-off, you're viewed as an imbecile.
Of course, we don't think you are, David.
If the stock market had done what the bond market has done, and I said, you know what, you want to get in the stock market, you'd be saying, well, what a brave, great call, Dave. No, but if you're in the bond market, you got to be a complete idiot.
So let me give voice to, I think, why maybe some people have fallen into that camp. Because there is this maybe feeling, and we started by talking about this, that it's kind of the U.S. has reached its day of reckoning, and that, as you pointed out, yields aren't going up because of the economy. They're not going up because of inflation. They're going up because the bond vigilantes are freaking out about the fiscal situation. Even if the economy is falling into recession and the Fed lowers rates with monetary policy and tries to address that, even if that's coming, what about that fiscal situation? Is there a risk that bonds those yields don't come down because they're still looking at that unsustainable fiscal situation? So, have they lost control of the treasury market? Is it going to remain elevated? Is that bull market not going to come because of the fiscal situation now? I think that's what people maybe are worried about, and that's why people say maybe treasuries are uninvestable now.
Uninvestable is I want to be polite.
You don't have to be.
Well, it's a ridiculous statement to make. It's ridiculous. I mean, Japan's got like a 200% debt to GDP. They've been, you could say, a fiscal basket case. The JGB market for years was a great place to put your money, especially when they had their intermittent sell-offs. Look how low their yields got in the face of massive deficits and debts. I'm not going to say it's not a problem. I'm not going to say
narrative. You see that as a false narrative. This idea that
what I'm trying to say is that, the people that just look at the deficit and say treasuries are uninvestable, it's a very myopic view. I mean, forecasting interest rates is a very complex task. You can't just have a one variable model. Is that what you're telling me? I got a one variable model on treasury yields and it's all about fiscal policy. One variable model. You're going to predicate your view. You have to have a macro view. I mean, because the deficits blow out every recession. And you're going to say to me, well, I can't buy treasuries in a recession because the fiscal deficit blows out because the automatic stabilizers kick in. Well, you would have missed out on probably every single major bond rally we've had in the post-World War II period. Like how stupid is that? It's just stupid. I'm not saying that there isn't concern. There obviously is concern to be incurring these deficits and debts at a period when the economy is not in recession runs the risk of what we're seeing right now. But you see, it's a game of cat and mouse because the bond market right now is tightening policy for the Fed, which is on hold. This is an exogenous shock on the economy. And this alone will trigger a further slowing in the economy, which is still quite slow. I think that, if I think a lot of people believe in Jay Powell. He uses the word solid. I can't remember how many times he used the word solid at the last FOMC meeting. I mean, quite frankly, I was laughing my ass off. Like, what is he looking at? But he's become America's economic cheerleader right after the president, and people believe him. And people who manage money believe him. I don't believe him. I've taken the other side of that bet. I understand why yields are going up. Okay, I understand that when you have uncertainty, you become risk averse. And so we've seen that. We've seen that in the bond market. There is the term premium is causing bond yields to go up. That's an exogenous negative shock. The stock market was starting to do that, but then of course, we had the reprieves. And you can talk about the big, beautiful bill. I kind of look at that as being more neutral, but we have a stock market of 21 on a forward multiple. Like we're back to almost where we were before the peak in February. If you told me, well, the multiple's 14, like where it is in the rest of the world, I'd be saying, well, that's an equity risk premium I can sink my teeth into. Maybe I'll be more bullish on stocks. Like, how can I could see somebody saying, 4.4% 3-month treasury bill yields. I'll just basically stay in at the short end. And I get that. And
Mm-hmm.
I'm there too.
Mm-hmm.
And then there's people that are saying, well, look at 5% long bond. Look like we could be heading there in the 10-year. I don't have a big inflation view, so I think those are attractive real yields. Again, it comes down, Maggie, to what is your assumption? If your assumption is the U.S. economy is recession-proof, just buy the S&P 500 forever, if that's your view. If your view is that this is going to be inflationary, like the tariffs are going to be inflationary, and I'm talking about multi-year inflationary, not, dare I use the word, transitory. Well, if that's your view, if you think the tariffs are going to be inflationary, you don't want to touch the long bond. You don't want to touch the treasury market, maybe the very front end. But you see, the thing is that I could see what's happening. I could see that this is going to do more to damage and impair real purchasing power of the household sector than create the conditions for inflation. And that demand destruction is going to create the conditions for inflation to go down more than would have been the case had the tariff war not started. You see what I'm saying? I think that inflation will come down more because of the tariffs, but it's going to have a hiccup for several months and then come crashing down because real demand is going to come down. And once again, that is in the soft data. University of Michigan numbers that came out very recently, and this is a number for May. What did it show you? It showed that about 2/3 of Americans do not even believe they're going to get a wage increase in the coming year. Well, how do I wrap my head around that from an inflation standpoint? We didn't have that in 2022 when people were job hopping and the quits rate was going up and companies couldn't hang on to their labor. That turned into a wage price spiral. That, again, is where people, even like myself, the inflation was only 18 months, but boy, it seemed like 18 years at the time. We had a wage price spiral because people were getting paid more from Uncle Sam and the states to stay out of work. The unemployment insurance benefits was like another lottery ticket on top of all the pandemic stimulus checks that were mailed out. You got paid not to work. Companies opened up. We reopened the economy with no labor, but there was demand for labor. So we had a wage price spiral going on for 18 months.
Right. None of those conditions are in place now. Like you see,
that's what I'm trying to say. So now, that the median, what the median in nominal terms, the median expected wage increase is in the household sector. You know what it is for the next year? You know what it is? 0.3%. 0.3. And the expectation of real wages is the most negative it's ever been in the history of the survey. So I find that very interesting. It's telling me there's a very good chance, because there's no such thing as 0 odds or 100 odds, very good chance that this price shock from the tariffs they hit a wall in the labor market. But you see, the thing is that people are fearing inflation. I can't touch treasuries. And people think we got this fiscal train wreck. We can't touch treasuries. And I'm saying that I don't see sustained inflation coming out of the tariff file, point number one. And point number two, on the fiscal side, I get it. And what I said before was that the supply is still going to be so gargantuan that it will limit the rally we're going to get. But to tell me that because of the fiscal situation, that a recession will not cause there to be a rally in treasuries, ignores what happens in terms of the implications a contraction in the economy has on credit demands in the household and business sector. They pull back their credit demands. The banks go through a delinquency and default cycle. What do the banks do? The banks are huge buyers of treasuries, for an example. In good times, the banks are not big buyers of treasuries because they're making loans. But part of the asset base of the banks are treasury notes and bonds. In a recession, they shift from non-liquid assets, which are loans to households and businesses, towards liquid assets on their balance sheet in the form of government debt. They become a very big buyer of the bonds that we're talking about.
Wow.
So you can't just look at interest rates and say, oh, well, fiscal. You have to take a look. You have, the models you run, they have to have like 8 or 10 variables. You can't run an interest rate model on one variable. And I would say that if we don't get a recession, we're in my bond calls is in trouble, because we're going to have an expansion economy where corporations and households will be competing with the government for more funds at a time when we're running $3 trillion just about of gross refinancing needs.
Yeah. Wow.
Now, I hope, look, I'm steadfast in my call, but I can hardly say that there's not a chance I won't be wrong. That's why my bullish call on treasuries hinges critically on the economy rolling over. Now, if it doesn't roll over and bond yields, there will be a point, and maybe it's not 5%, maybe it's 6 or 6.5%. There will be a point where the interest rates will act as a major constraint on the economy. So it could just be more of a timing issue. But then again, if I'm wrong on this call, you're going to be sorry you held on to your long duration portfolio in treasuries. You would have wished that you never bought this sell off in treasuries, 100%.
Right.
But I'm seeing, nobody else is seeing the whites of the eyes of the economy. I am starting to see things that are making me even more confident than I was in 2022. And it's a bit of a waiting game right now, but not a waiting game. It's not like Rosenberg, do I have to wait 12 months for your call to play out? No, I think it'll be in the next 2 or 3 months. And I'm not saying to anybody, you got to rush right now.
Right.
But I do think that the second half of the year, the surprise will be how weak the economy is. And I'm not expecting there to be a massive monumental rally at the long end of the curve. But, because of the convexity, Maggie, at this stage at 5% plus in the long bond, you don't need to have a monster rally to generate a 10% total return. You don't need to have it. You have so much coupon protection right now.
Yeah. It sounds like in that scenario, you still believe that, or do you still believe that a sort of, I don't want to say 60-40, but that bonds do offer a safe haven and opportunity and diversification in a portfolio? Because the other narrative, as you know, is that 60-40 is dead, right? Like we're done with that time, and bonds are not an offset to stocks.
Well, frankly, I never believed that 60-40 was a relic of the past, but that was certainly the mantra, a lot more even in 2022, when both asset classes fell out of bed. You had a horrible year for the stock market, horrible year for the bond market, and then the horrible year for the bond market extended through the first 10 months of 2023, and the stock market got bailed out by ChatGPT and NVIDIA starting in the fall of 2022. I don't accept the premise philosophically, because over time, those two asset classes, treasuries and equities, will trade in a non-correlated fashion. Okay. They're both totally different animals. I don't know. I can understand there's going to be years where it's going to be rough in the treasury market. It all depends on whether you're a trader or whether you're an investor. I guess that, in that period where there was Tina, remember Tina, there was no alternative, and rates are at zero at the short end, and they're 1% or less. At one point, I think the 10-year note was like 0.6. The yield on the stock market was incredible, and the stock market was a great buy. But, I'm taking a look right now, and you have, say, 4.6% 10-year, 5% plus long bond, and the earnings yield in the stock market is 4.6%. So basically, the stock market is trading as though it's a risk-free asset. When you think about it, when the equity risk premium is zero, that's what it's telling you. It's telling you, but equities have capital risk. And the thing about treasuries is that there is duration risk and there is inflation risk. You could argue, of course, there's fiscal risk. Those are different risks. But treasuries don't have capital risk. And the thing about whether you're buying a 5-year or 10-year or long bond, you know what you're getting paid. Like, you know with certainty. It's really what makes treasuries attractive. It's always a matter of, I don't know if it's 60-40. Maybe it's 80-20, or maybe it's 50-50, depending on where you are in the cycle. But to tell me I never own treasuries, I mean, 60-40 is just whatever benchmark that just got made up, 60-40. It could be 70-30. It could be 65-35. But treasuries are a balance in the portfolio. And it doesn't mean that you will not incur a loss if you're forced to sell in a bear market. But you got a guaranteed coupon, and you know that you're getting paid your capital at the end of the term, which you don't have. You don't have that in the stock market. So the bond market gives you, at any continuum across the investment cycle, the bond market will not only give you a guaranteed flow of income, but also a guarantee that your capital will not be impaired. So, by virtue of the fact that there are different risks, there's capital risk in the stock market, there is recession risk in the stock market, there's earnings risk in the stock market, and then in the bond market, the risks are different. I'm not talking about the corporate bond market, but in the government bond market, you do have, like I said, there's duration risk. There is inflation risk. There's fiscal risk. Those are different risks. So I don't believe that you put all your pile of money into one particular asset class. I think you should be diversified. I don't think you should be crazy diversified, because then it becomes unmanageable. But to tell me that I'm out of the treasury market, that it's uninvestable. Just hearing that from you, because I imagine you're hearing it from other people.
I am.
Just hearing that tells me that probably most of this move is over, because, boy, that is wild negative sentiment. I can only tell you that if I ever heard people talking about that the equity market was uninvestable, if I started hearing that from people, if we had this conversation and you told me the S&P is uninvestable, I'm going to tell you I would start buying as soon as I got off the call.
It's a good sentiment indicator. Just quickly, the dollar, does the level of dollar factor into your scenario at all? Does it matter? Do you expect it to move lower?
Well, I think that, this is not the era of Bob Rubin in the 90s, when Bob Rubin said over and over again, we are carrying out a strong dollar policy. These are Democrats. Bob Rubin consistently said a strong dollar is in America's best interest. And in fact, if you go back to that period in 94, after the tequila crisis, when the U.S. had to bail out Mexico with those Tesla bonos, the dollar went into a bit of a tailspin. And Rubin kept on saying the same thing to instill confidence. And actually, even Alan Greenspan gave a famous speech where he said that the drop in the dollar is both, in quotes, unwelcome and troublesome. And that actually helped put him the low. Today, Jay Powell will never talk about the dollar. Oh, that's Treasury's responsibility. It's always Treasury's responsibility. It seems as though that the administration wants to have a weaker dollar. It doesn't make the Fed's job any easier, that's for sure. But it's probably part of their pro-growth package. I started getting sort of a little nervous when, months ago, we started hearing about this Mar-a-Lago Accords and so on and so forth. But we are hearing, actually, from credible sources very recently that there have been talks between the White House and some of the Asian countries out there, like Taiwan and like Japan and Korea. The Asian FX complex has really started to strengthen. And of course, I think that there's some pressure, I think, as well, for the Japanese to start to sanction a stronger yen. Let me just tell you that the most recent trade that I did was I bought a whack load of naked long Japanese yen, just the yen, that's it. When it was a 150, now it's 143. because of course I only talk about my good trades. But I would say that, yeah, when something's happening that's not supposed to happen, you start to pay attention. The U.S. dollar should be strengthening, but it's weakening. But you have to understand that the one thing about currencies, unlike most other asset classes, they are politically manipulated.
Mm,
Remember the Plaza Accord? That wasn't about the equity market or the bond market. That was about the dollar. The
mm,
Louvre Accord, that was all about the dollar. So you see the foreign exchange market is, of all the markets, the most politically, I shouldn't say manipulated, let's say politically motivated. And it seems as though there is a policy bent towards weakening the US dollar. Um, well, that tells me that if I'm going to be invested, why would I not be invested in other parts of the world where the average multiple is 14, not 21, and with stronger currencies, and by the way, with central banks that are cutting interest rates?
mm-hmm.
So I'm actually not unremittingly negative on the equity market. I just don't like where the S&P 500 is priced. It's the most expensive stock market in the world, and it's competing against more challenging interest rates and a policy bent towards a softer currency. I'd rather be in Canada, to tell you the truth, despite all the warts and pimples and scars north of the border. Asia continues to screen very well in our work, and so does Europe. So I am in equities, ROW, rest of world, and I'm trying to block out the noise. I understand why yields have backed up. Tell you the truth, I'd be more concerned if yields are backing up because of the real rate or inflation expectations. I'd be more worried about a repeat of 2022. When it's the term premium and it's exogenous, there will be a time where it will start to really bite the economy and the stock market.
So that's almost the trigger. In a weird way, it can be the trigger for your recession, or part of the catalyst, and ultimately your bull bond call.
Yeah, and look, I'm bullish on bonds now. It's am I a secular bull? No, I'm a cyclical bull. And once I see the whites of the eyes of the recovery, I'll shift out of treasuries. And like I said, I don't want people to get the wrong idea. It's not like this guy is like, oh my God, he's like never changes his view. Um, I think that the low in yields were, if it wasn't for the policies we're seeing out of the White House, I could see this cycle going to where the funds rate would probably go 100 basis points below neutral, which would be close to 2. And I would see the 10-year going to 2.75. There was a time when I thought that could have been a base case. Sounds aggressive, but in recessions, the funds rate does go below neutral, and it drags the whole curve along with it as the curve steepens. We're not going. I don't think we're going unless we got just a total unmitigated disaster. That's not going to happen. So I'm bullish on treasuries, but don't get the wrong idea. I am a relative to my past on the
Mhm.
fixed income market. I am a restrained bull, but I'm still a bull. If you're going to say to me right now, gun against my head, where would you have if you had to put all your money in either stocks or in treasuries? Well, I'd be I wouldn't have to flip a coin. I would be in treasuries right now, based on my economic view, but also the math. The math, the relative yield is just much more compelling at this point. You've reached such a point now in the long bond that you'd have to have just a much more monumental move upwards in yields to generate a negative return in the treasury market. Unlike what happened, when people talk about that horrible period in treasuries in 2022, when your starting point on the coupon is like less than 1%, you don't need that big of a move in yields to all of a sudden see everything wiped out and then some, and you trigger losses. You have a lot of coupon protection right now. Even if you believe this is uninvestable, from here it has to get like really, really bad. This is like talking about like 1982 in equities. Like you got to go from a 12 multiple down to 8, you know?
Mm.
So you do have that coupon protection. I don't have an inflation view. I think that the combination of what's happening on real rate on the term premium, coupled with the tariff shock hitting the consumer harder than people think, is going to generate a recession. And in recessions, you really want to play it safe. I'm not saying that treasuries are the only thing. I think that as the dollar goes down, the best hedge is going to be gold. If I understood Bitcoin more, and if I was a speculator, which I'm not, they say digital gold. I say, well, I'll just buy the real thing. But gold is going to continue to be a very good place to be as well.
David, such a fantastic conversation, and I just want to say that we love that you're fearless and that you'll you'll give it to us straight regardless of what the rest of the crowd is saying. We depend on that when we talk to you. So thank you so much.
Well, as Mark Carney famously said, elbows up.
I love it. David Rosenberg, thanks so much.